We are live,
Nice.
family. Listen,
Man,
after all the technical difficulties, we are here. We
man.
about to flex on it financially. Ain't that right, Cam?
That's right. Flex and Financials here. Cam, I'm about to teach you guys about collecting premium in the stock market so you can get those profits and PJs.
Listen.
That's a fact. That's a fact. YouTube was hating on us for a little bit, but we here. You can't stop the program. We
Mm-mm.
appreciate y'all being patient. We appreciate y'all showing up. We know it's been a little minute, man. It's been a little minute since we had supplemental Sundays. From now on, we probably not gonna be weekly just because we've taught so much stuff. We kind of like running out of stuff to teach. But if you like Cam, who I put a word out there. Hey, anybody know how to sell options? Please let me know. We need a presenter. And he hit me in the DMs like, bro, that's what I do. That's how I get my bread. Like, I'd be more than happy to show y'all, how to do this. So I was like, bet. He sent me the presentation. It was lit. So we here now. So if any of y'all, feel that same way about anything, financials, any markets, and you want to share your expertise or you want to share a way that you make money, even if it's not markets, share a way you make money. We in some hard economic times. We got a lot of people that watch this show that have different talents. You never know. If you know a way to make money and you want to share it, you made a lot of money doing it, you good at talking to people, we got a platform for you. So just let me know. But like I said, we here today. Don't want to waste no time. We got Cam. He got a nice presentation. I went through it myself because I don't know him. I just met him. Seems like a good dude. Seems like he knows what he's talking about. And we're going to let him take the floor to teach us how to sell calls and puts to make some income. Sir, appreciate y'all having me on. Yeah, happy to share all the knowledge that I have when it comes to selling calls and puts. And yeah, I guess I'll just jump right into it. Let me go ahead and get this presentation going. Is the presentation visible?
Yes, sir. Yes. Just put it in presentation. There you go. Perfect.
There you go. All right, cool. All right, everybody. So this is obviously a presentation on selling options for additional income. This is a strategy that I used to be able to actually walk away from my day job and be able to create content full-time and trade full-time. And as you can see down there in the subtext, it says profits and PJs. That's one of like my main hashtags and slogans over at Flex and Financials. And it basically is you being able to get money without actually extending your labor. You can do it from the comfort of your own home on your own time. And for some people, like myself, I like to do it while still in my pajamas. So without further ado, let's get right into it. All right, so real quick, who am I? My name is Cameron. Most people call me Cam Tucker. 24 years old, and I live here in Seattle, Washington, along with Mark and Jolene, so that's pretty cool. Graduated from Morehouse College. I know I had to rep the set on the show real quick. Graduated in 2020 with a computer science degree. So after college, I went on to be a software engineer at Amazon, and I did that for 14 months and 3 days exactly. I kept count because I was ready to get out. So that's why I took trading really seriously. From there, I went on to actually take the leap and start Flex and Financials, which is a brand where I teach people about building wealth in the stock market. And yeah, it's not like a bunch of gimmick stuff. It's like intuitive gems that you can put into action right away. And yeah, I just post daily gems on Instagram. So feel free to follow me there, Flex and Financials, same way that it's spelled right behind me and on the Zoom link. And yeah, I'm also options day trader. So I primarily trade the S&P 500 and NASDAQ. I'm a big advocate for only trading like these two things. They're very liquid and they present opportunities every day. So why complicate things? And finally, since this is the Come Up series, I had to introduce myself as a cousin. So I like to call myself the bodybuilding cousin. I come from a bodybuilding background, hence the flexing part of Flex and Financials. So let's go. All right, so on the agenda today, again, we're going to be talking about selling cash secured puts and covered calls for income and doing it profitably. So I'm going to teach you guys personal tips and nuances when it comes to doing this, as well as any mistakes to avoid when it comes to selling options. So why sell options? Most people watching this, you likely are used to only buying options and not actually being on the other side of the transaction. But honestly, like selling options is kind of the place to be. You can kind of think of it like a casino. A lot of you guys have probably heard of like the saying where the house always wins. And that's kind of true when it comes to selling options. Most options expire worthless. So you as the seller benefit from all of these options expiring worthless. You're collecting the premium continuously. And of course, just like a casino, sometimes they'll have to pay out the people that win and stuff. But there's so many people that lose that those times that they actually do have to pay out those amounts, it doesn't really matter to them. And it's kind of the same thing on your end too. So yeah, the odds are just drastically in your favor. You're kind of in the driver's seat and you have more control versus when it comes to buying options. So yeah, essentially you're just getting paid to either buy shares at a discount, which is on the selling put side, or you're getting paid to potentially sell shares for profit, which is on the covered call side. So yeah, let's go in and actually talk about the two strategies. All right, so when it comes to cash secured puts, this is actually one of the most common ways and conservative ways to generate income when you're trading. And actually, fun fact, Warren Buffett made a lot of his fortune by selling put options. And so basically what you're doing when you sell a put, it's basically the opposite of what most of you guys are probably used to when you buy put options. So you sell the put to somebody who's buying it, and in exchange for that, you're collecting the premium. And you get to keep this premium no matter what happens, if the stock goes up, down, whatever. The only reason that you wouldn't keep the premium is by something that you would voluntarily do, which is buying back your contracts, which we'll talk about that a little bit later. But yeah, the gist of how this works is that if the option contract expires in the money, then for every contract that you sell, you must buy 100 shares of that stock at the strike price that you choose to sell the option contract at. So let's say that you sell an Apple put option with the $100 strike price, then that means that you have to have enough money to buy those 100 shares of Apple at $100 per share. So that would be $10,000 in that example. And this money will be locked up as collateral. So kind of think of that as like a security deposit when you go to like, say, like an Airbnb or something. They keep your money. If you break something, they'll keep it and use that towards whatever you broke. But if everything goes fine, then once you move out of the Airbnb, you get your money back and you can do with that whatever you want. So continuing on, if the option contract does not expire in the money, then that means that you still, again, get to keep that premium regardless, and your collateral is released and you can start using it again. You can use it to make other trades, or like it doesn't matter, like the collateral is released and it's liquid money again. So people with a lot of capital, like the hedge funds of the world, they like to use this strategy because it takes a lot less effort to make money when you have a lot of money. And like I said, option contracts usually expire worthless because they're the ones that are actually pretty much determining the prices, right? Like us retail traders, we don't have enough money to actually move the candlestick. So they're the ones that are dictating this price action. So this is a good way for them to continuously make money off of a lot of people buying options every single week. And yeah, again, this is just a good way for you to buy shares on a discount, because as you collect that premium, then now you're in turn having to pay less for those shares. And so your cost basis that you're actually paying when you're selling puts is the strike price times 100 because of 100 shares, and then minus whatever the premium is that you collected for the contract. So let's do an example just for simple math. Let's say, again, like we're selling a put on Apple at a strike price of $100. So that would be 100 times 100 shares. So that's $10,000. But then let's say I collected $400 in premium, you would take that away from the $10,000. So instead of me paying $10,000, for 100 shares of Apple, I'm only paying $9,600. But on top of that, let's say that I'm selling cash secured puts every single week, that premium that I'm collecting is starting to add up. So it's taking away more and more money from the cost basis, which is allowing me to get the shares on a discount, like I was saying just a couple seconds ago. So if we look at a cash secured put example, sorry, you guys' faces is blocking the presentation. All right. So yeah, this is an example of a Walmart cash secured put. It's a little bit old, the expiration is already passed, but that's not important. And basically, as you can see here, this option is for the $140 strike, and the premium for this is $205, and it expired on February 18th. So if I were to sell this contract, I would be paid $205 up front. And again, like that money is mine. And what the contract is saying is that if Walmart closes at or below $140 on February 18th, then I will be obligated to buy 140 shares of Walmart stock at $140 per share. However, if the contract expires out of the money and it doesn't close at or below $140, then I was able to keep that $205 in premium, no questions asked. I can sell like another put if I want to. I can go make any other trade, like do whatever I want with the money, it doesn't matter. So yeah, that's what this contract is saying. All right. So here are some tips that I learned throughout my time when it comes to selling cash secured puts. So it's best to sell put options when stock prices have dropped dramatically and on big red days. So those days where like the S&P and the NASDAQ are down like 2-3%, or when the stocks are like really, really bloody, those are the best days to sell. And the reason for that, is because one, the cheaper or like the lower of the strike price that you're selling at, that means obviously that you're able to, if you were to be assigned and have to buy the shares, you'd be getting them at a better price. So that's the first reason. And the second reason is that the premiums themselves are more juiced up, right? We all know that when there's huge drops or rips in the stock market, that's when premiums and implied volatility get inflated. So you'll be benefiting from that as well as an option seller. And it's also best to sell at strike prices that are around areas of support or major moving averages, because since we are selling puts, and for most people, your goal is to not get assigned when you're selling those puts. If you're selling at areas of support or major moving averages, that means that it's likely that the stock is going to end up bouncing back to the upside. And then that strike price won't actually expire and the money, and you'll be able to keep that premium scot-free and sell puts in the future. And finally, it's best to not sell put options around any expiration dates that are near earnings reports or major events, such as like the Federal Reserve FOMC meetings. And the reason for this is, the same reason why you just don't play earnings in general. Like anything can happen. There's potential for crazy price swings. So like, imagine if you had sold like a $400 put or something back when Netflix dropped like $100 overnight. Like you would be pretty much putting yourself at like a huge loss, pretty much like that, just because you wanted to take advantage of like the higher premium from earnings. But now you're going to be sitting holding the bag on Netflix by being in the hole over $100 per share. So it's definitely not worth it. Definitely stay away from earnings and like really big events that can cause huge price swings. All right, so real quick, I hope you guys can see this chart. This is the chart for AMD. The prices are like cut off, but that's not really too important. But basically, as I was saying, like it's good for selling puts around areas of support here. So on this AMD chart, this is the $72 level. And as you can see here, AMD has bounced 1, 2, 3, 4, 5, and now it's nearing $72 once again. The stock price. So like $72 for AMD, and any other area of support is usually where you'd want to be selling, because as you can see here, it has a high likelihood of bouncing back to the upside, meaning that there's a high likelihood that you would not be assigned at the strike price. All right. So finally, on to some of the risks of selling cash secured puts. So in the event of assignment, the stock may still continue to drop, right? Like if you are assigned and you're forced to buy the 100 shares per contract that you sell, like there's no telling that the stock will just kind of consolidate at that area or go up or go down, like nobody knows. But in the worst case scenario, there's a possibility that it will continue to drop so much even to zero. Obviously, this is highly unlikely unless you're like playing like some penny stocks that like nobody really knows about and they could go bankrupt. But if you're doing something like Apple, the stock going to $0 is like virtually impossible. But yeah, so your max loss would be though your cost basis in the worst case scenario, but that's just the same as you investing in general. And then on top of that, if for whatever reason you decide that you no longer want the obligation to buy 100 shares per contract that you sell, then you would have to, the only way that you can relieve your obligation from having to buy those 100 shares is actually buying your contracts back. And most likely the only reason that you would want to be doing that is just like if you ended up changing your mind like mid-trade and the stock is either at your strike price or below your strike price, meaning that it's in the money. But at that point, the contracts would likely be more than what you actually sold them for, meaning that you would be at a loss for that trade. So say you sold your contracts and you were paid $200 for the premium, but then the stock ended up dropping down to your strike price, and now the contracts are $400 for the premium. That means that you'd have to come out of pocket $200 to eliminate your obligation to buy the shares, which would obviously have you at a loss for that trade. All right, so before we go into the covered calls section, Tivo, AJ, like I can't see the YouTube chat or anything. I don't know, like if there's questions so far.
I think you good so far.
Doing great.
All good so far. Cool. All right, so moving on now to the other half of this, which is the covered calls section. So again, covered calls is one of the most common ways when it comes to generating income in the stock market. And again, it's just the opposite of what you're probably used to, right? We talk about leaps all the time on this channel and in this community. So a lot of people are used to buying call options, but very few of you guys are used to selling call options. And so basically what you're doing is you're writing the call or you're selling it to the open market. And in exchange for this, people are paying you a premium. And again, you get to keep that premium no matter what happens. So if the option contract expires in the money, then that means that you have to sell 100 shares per contract that you sold at that strike price. So let's say that you sell an Apple call for $120. If Apple expires at $125, then you're obligated to sell your shares at $120 per contract that you sold. And you must already own the 100 shares. Hence why it's called a covered call, because you have the shares to be able to cover your obligation. All right. So just like when it comes to cash secured puts, if the option contract expires out of the money, then you just got paid that premium, no strings attached, the option expired worthless, and you're good to go. So yeah, again, those with a lot of capital, they like to use this strategy to just generate income week after week from people that are buying call options, which most retail traders usually do. And a lot of them get frustrated because again, most options expire worthless. But yeah, covered calls, they're just a great way for you to collect income by holding your shares. Like to me, I like to think of covered calls as like collecting rent on your shares, right? Kind of like a rental property. You own the house and you're benefiting from the house's appreciation, but then you're also collecting that income from like the tenants that are living there. It's kind of the same thing when it comes to covered calls. You're owning the shares and you get to benefit from the appreciation of the shares going up, like over the long term, but then you also get to collect some additional income on top of that, which is really nice. You can use it to like buy the dip or, you know, whatever you want. And yeah, so your total profit in this case is the strike price times 100 because of the 100 shares. and then plus the premium collected minus your cost basis. So that like seems like a crazy equation. So let's just run through an example. Let's say that you're selling a Apple cover call for $100. So it would be $100 times 100 shares. So again, that's $10,000. And now let's say that we collected $400 for our premium. So now we have $10,400. But now, since let's say like our cost basis, let's say we got into Apple at $90 per share, and we have 100 shares. So you just subtract that 9,000, and that means that if you were to be assigned at the $100 strike price, then you would be profiting $1,400 in that example. But obviously, the more times you sell premium, this amount of profit increases over time. And none of this strategy is like a get rich quick scheme. Like you're not gonna 100x your account like overnight or anything like that. Like this is just a sustainable strategy that allows you to bring in money consistently and gives you just additional buying power or whatever you want to use the money for. All right, so let's look at a covered call example real quick. So here over here we have a Apple call option, $180 strike price. The premium for this is $313. And again, this is slightly old, but that's not really too important. And so, yeah, what this contract is saying is that if Apple closes at or above $180 on February 18th, then you will be obligated to sell 100 shares per contract that you sold of Apple at $180 per share. However, if Apple expires out of the money, aka it does not close at or above $180 on February 18th, then you were paid this premium and you did not have to buy the shares and you got to keep the premium, no strings attached, and you can go on and sell more covered calls the next week, the next month, however frequently you want to do it. So some tips when it comes to selling covered calls. It's kind of the opposite of selling puts, basically. So you want to sell when stock prices have risen a ton or on super huge green days. So again, like when the indices are up like 2 to 3%. And there's two reasons for this. Number one, the higher strike price that you choose, that obviously means the higher price that you're able to sell your shares at, which means that you get to make more money in the event that you're assigned and have to sell your shares. And then two, again, on really big bullish days, that inflates the implied volatility and it inflates the premiums, which again, as an option seller, that's in your best benefit. And it's best to sell at strike prices around levels of resistance, so kind of opposite to the cash secured puts when we were talking about the support levels. Instead, when it comes to covered calls, since you want the stock to come back down, you want to sell at areas of resistance. And just like with cash secured puts, it's best to not sell option contracts around expiration dates that are near earnings reports and major events, again, such as like FOMC meetings and things like that, because of the huge price swings. So we don't have to go through that again. All right, real quick, as an example of like where you would be looking to sell your covered call at, this is a chart from Palantir back in the day when it was trading like in that high or like that $20 range. Here, as you can see, Palantir bounced off of or rejected off of the $27 level multiple times. So like these would have been great areas for you to sell your covered call at, because obviously the price ended up rejecting off of this level pretty much every single time. And the same goes for like all stocks. They all have support and resistance levels. All right, so moving on to some of the risks when it comes to selling covered calls. So the first risk, which is only a self-inflicted risk, really. So it's always in your control, but you may be forced to sell your shares at a loss. But as I was just saying, this can be avoided if you just choose the right strike price and a valid strike price that works for you, because it's going to be different for everybody. But yeah, as long as you choose the correct strike price, which we'll talk about a little bit later, like this won't really be an issue for you, but it still is a risk if you don't know about it up front. And then another thing, which isn't really a risk, it's just more of a con of selling covered calls, is that your max profit is limited, unlike buying call options. So that's one of the more attractive features of buying call options, is that, again, like you can make a ton of money in a very short amount of time because your profit is unlimited. However, when it comes to selling options, it's just the premium is what you get to keep, right? Of course, on top of like selling your shares, but between you selling your shares and the premium that you're collecting, that's the maximum amount of money that you can make. So again, it's not a risk, it's just a slight downside when it comes to selling calls. And finally, if that for whatever reason, you no longer want the obligation to sell your shares, then just like with selling cash secured puts, there is a chance that you will have to buy your contracts back, which will relieve you of that obligation of selling your shares, but you're going to have to pay more for the contracts than what you sold them for, which will put you at a loss. So that's why it's crucial to only choose strike prices, whether you're selling covered calls or selling cash secured puts, only choose strike prices that you're comfortable with. Don't just be out here choosing strike prices just because the premium at that strike price looks really good. Like, it has to be something where you ask yourself, okay, if I'm assigned at this price, am I okay with it no matter what happens? Like, as long as the answer to that question is always yes, you'll be good with the strategy. All right, so on that note, let's talk about choosing the correct strike price. That way you can be confident in every single trade that you make when it comes to selling premium. Let's go. All right, so on the cash secured put front, when it comes to picking the correct strike price, it is crucial that you only choose strike prices that you would be comfortable buying shares at, nothing higher. So let's say that I only want to sell, or let's say that I'm only comfortable with buying Apple at $80 per share, then I should not just be selling cash secured puts at $100 per share. Like, I shouldn't just be like, oh, well, Apple's at like 110 right now, so let me just sell like a $100 put, because it probably won't get there. Because if it does get there, then I'll be upset, I'll be uncomfortable, I'll be up at night stressing about it, and nobody wants that. So only sell cash secured puts at levels that you're comfortable with. Kind of to piggyback on what I was just saying, your objective is to make additional income investing the way that you normally would. So don't do things that are out of character. Like, this is just a supplement to what you're already doing. And yeah, your objective is not to make money by choosing strike prices that are going to stress you out and keep you up at night. All right, so choosing the right strike price when it comes to covered calls. Basically, it's crucial that, again, you choose strike prices that are above your cost basis, because in strike prices that you're okay with selling your shares at. That way you never end up in a predicament where you have to buy your contracts back and potentially end up losing money because you had to pay more for the contracts than what you sold them for. So let's say that my cost basis for Apple is $100 per share, then it doesn't make sense for me to sell at strike prices at 95 or 97.5 or like whatever. Like, it should always be $100 or more, because that's the only way that I can profit off of actually selling these covered calls. Even if I'm consistently collecting premium below that, below whatever my cost basis is, like, I still, at least for me personally, I never want to have to get assigned out of my shares below my cost basis, because that kind of complicates things and starts introducing like wash sales, depending on how often like I'm selling premium, like things just get really messy. So it's always good to sell covered calls above your cost basis, or at least equal to it. And again, your objective is to make additional income investing ways that you normally would, and not just to be out here collecting premium just for the sake of doing it. Some people do it that way, and they like keep track of their premium and their cost basis and like a spreadsheet and stuff. And if you can do that, if it works for you, but for me, this is just my style, what I'm teaching you guys here today. All right. And then another way that you can like pick out your strike prices is by using the Greek delta. So we've talked about options tons of times on here for the come up series. So I hope most of you guys know about delta, but if you don't, real quick, delta is one of the 5 Greeks when it comes to options, and it's the most important one. And for every dollar that the underlying stock moves for that contract, that's how much the premium will fluctuate. It will fluctuate by that delta value. But more importantly, when it comes to picking strike prices, delta is considered to be the probability of whether or not that option contract will end up expiring in the money. So obviously contracts that are closer to the money or deeper in the money, they're going to have a higher delta value because obviously the probability of it expiring in the money is higher. So if we look at delta really quick for an example, this is a Apple call option contract and it has a delta of 0.63. So basically what this is saying is that this contract has a 63% chance of closing at or above $170 by the expiration date for this contract. But as an option seller, you typically want to look at contracts that have a delta of 0.3 or less. So a 30% chance or less of expiring in the money. That's usually the sweet spot where you're going to be able to consistently sell either cover calls or cash secured puts without getting assigned. And you'll just be able to every single week or bi-weekly, monthly, however often you want to do this, you'll just be able to consistently bring in money. All right, so finally, to wrap things up, we're going to talk about the wheel strategy. And this kind of ties everything together that we've talked about so far when it comes to cash secured puts and selling cover calls. So what is the wheel strategy? The wheel strategy basically combines both selling cash secured puts and cover calls, and it allows you to do this in a cyclical manner, hence the name of the strategy, right? The wheel rotates and the strategy involves a rotation. So basically, this is how it works. You either start off selling cash secured puts or you start off selling cover calls. It doesn't matter. It's up to you. Some people already own shares, so they can start with cover calls. Some people have a bunch of cash on the sideline and they can sell, or they can start off with selling cash secured puts, like whatever, like it's going to work differently for different people. But whichever one you choose to start with, you do this until you're assigned. So let's say, for example, I start off with selling cash secured puts. I'll sell a cash secured put, and if I'm not assigned, great, then I'll do it the next week. And let's say I'm not assigned again, great, I do it another week. And then finally on that third week, I got assigned. And let's say I got assigned at $100 selling a put for Apple. So then now I had to buy those shares, which means now that I'm holding them, which means that now I can flip and rotate and start selling cover calls on Apple, right? So I got into Apple at $100 per share, and now I would start selling cover calls. And remember what I talked about, you want to always sell above your cost basis. So now in this case, I would start selling cover calls at, let's say, $105 or $110 or like whatever I feel comfortable with. And I'll basically just replicate this rotation, like each rotation after rotation after rotation. So I start selling cash secured puts, then I get assigned and I go over to cover calls, then I get assigned and then I start selling cash secured puts again, and it just goes in that rotational manner like that. And yeah, so continuing on with the wheel strategy, due to the fact that you are kind of moving in and out of this stock position, it's crucial that you remember and you respect the price that you were assigned at in the previous rotation. So again, let's say that I sold a cover call for Apple and I got assigned at $120 per share. And so now I have a bunch of cash sitting on the sideline. I'm like, all right, I'm going to start selling puts. That means that I should be selling puts at strike prices that are at $120, since that's where I just was last assigned, or better. So like it could be 115, 110, whatever, but I don't want to be selling up at 130 because now I'm leaving a bunch of money on the table. I'm not necessarily losing money, but it's just better for you to respect wherever it was that you were previously assigned, or try to get a better price than you once had. So yeah, just another example down below of kind of what I just said. You don't want to be selling cover calls at a strike price of $80 if you were just assigned at $100, because that wouldn't really make any sense. All right, so frequently asked questions when it comes to this strategy. So a lot of people ask like, what expiration date should I choose? Or like, how often should I do this? And the answer is that it's really up to you. Like, you can either choose to do this weekly, which is what I do, but some people like to do it every other week or bi-weekly. Some people like to do it monthly. Like it really just depends on like you, how often you want to be watching the market, things of that nature. Other people ask, is this small account friendly? And to me, like a small account is like anywhere from like $5,000 to $10,000 or less. And my recommendation is definitely for $5,000 or above. And this is just because if it's anything less than that, you're likely going to be messing around with like penny stocks, and just stocks that aren't really too proven or don't have too much institutional ownership and things like that. And you just don't want to end up in like stocks that can have massive drawdowns because they aren't proven. Like we've seen a lot of this really in this specific market right now. Like a lot of like the growth stocks and speculative stocks are getting hammered. And then what is the typical return on investment for this strategy? So it really depends on like how conservative or aggressive you are with this strategy. But typically your expected ROI would be anywhere between 1% to 2% of your account size per month. But obviously like there's 12 months in a year. So like that adds up to be anywhere between 12 to 24%, which is pretty good. I mean, the stock market on average averages about 10% per year. So if you're doing 1% to 2% per month, you're looking nice. All right, so then just final gems. Again, like I was kind of saying earlier, this strategy is a supplement to the way that you're already investing, right? So a lot of people, like I said before, this strategy isn't like a get rich quick kind of thing. So you're not gonna 100x your account in a couple of weeks. Like this strategy is something that you can do consistently to bring in additional income. So first you might only start out making $50 or $100 per month, but like, who cares? Like this is just money that now you no longer have to actively go out and work for, that you can now reinvest, buy more shares, right? Or have more cash on the sideline to sell more puts. Like the more capital you have, the more shares you have, the more contracts that you can sell, the more money that you can bring in. So like you just got to keep your head down and remember that these gains are going to compound over time. And yeah, like I was just saying, like focus on the process over the profits. Like you can start small if you're like not feeling too comfortable with the strategy yet. And then once you start to get your feet wet and understand kind of how the wheel strategy works and how selling premium works, then you can start scaling up from there. And then the great words of Chris Johnson, he's kind of what got me into this whole wealth building thing and taking it very seriously in general. Just get money and buy income. So you want to take this premium, at least this is how I did it. You want to take the premium that you're collecting week after week or month after month or whatever, and reinvest it and keep buying shares or selling cash secured puts. And that nest egg will just keep increasing. And next thing you know, you'll be making some pretty crazy profits. So yeah, that's pretty much it for me. If you found this presentation helpful, feel free to follow me on Instagram. Like I said, I post daily gems on there when it comes to building wealth in the stock market. I also trade live on my Instagram stories and show people like what I'm looking at and just my thought process behind each trade and everything like that. So if that sounds like your kind of thing, we'd love to have you over at Flex and Financials. It's a great community and it's growing pretty fast. So that's pretty much it for me in the presentation. Hope you guys found it helpful.
Listen, I found it helpful, so I know they will find it helpful.
Yeah, no, the way you broke it down, you know, people have been waiting for how to do this, because a lot of the videos that are online about this are kind of convoluted, or they're just, I don't know, they're kind of all over the place and they make it seem way more complicated than it actually is. So no, the way you broke it down, we definitely appreciate it, bro. You did a really good job.
You did.
Good job. We do have a few questions for you if you are ready for those.
Yep, go ahead. Shoot.
So one person just wanted to be clear on how to close the trade. So like when you buy a call, you know, you have to sell the call to close it out? How do you close after you sell a call or sell a put?
So it's going to depend on like what platform that you're using. Like if it's on Robinhood, let's go over to one of these pictures real quick. Right. So if it's like on Robinhood, like this is kind of, can you guys see my mouse or just the screen?
Yeah, we see the mouse too.
Okay, cool. So yeah, like when you're going to sell the cover call, you would just be like on this sell button here and like the call button over here. So then if you're going to actually buy your contract back, then you would just toggle like over to the buy side, but then stay on the call side. And that's like how you would actually relieve yourself of the obligation when it comes to Robinhood. But for people who use like Fidelity or pretty much any other platform other than Robinhood, then it would be different. So when you're actually when you're first selling the contract, you do what's called sell to open. And that's like what actually opens the contract and you collect the premium and all that good stuff. But if you decide that you want to then get out of the trade and like relieve yourself of the obligation, then what you would be doing is called buy to close instead. So it's basically like whatever you did the first time to open the contract, you just want to do the opposite. So if you sold to open, then you want to buy to close, if that makes sense.
Got you. Okay. And you can do that at any point in time?
Yeah. So you don't have to wait until like the expiration date. Like as long as the contract is open, you can close it at any time. Now, whether or not the liquidity is there, which usually it is, as long as you're trading anything that's like relatively known, there's going to be somebody that's going to be there to either sell you the contract back or buy the contract from you.
Got you. Okay. And then let me see. I know you said that. So are you saying when you say 5,000, are you saying that's like in general what you would recommend having to start out doing this strategy?
What I recommend to start is, especially like Robinhood, now that they have the watch list feature, like it's like a stress-free and liability-free way for you to like test out the strategy and see like what would have happened if you actually sold the put/call live. But if you're just like one of those people who you're like, you know what, I learned best from like experience and having skin in the game, then yeah, like I would recommend only having like $5,000. It's not nearly the same as like you starting like a day trading account with $5,000 because like it's much easier for you to lose that money, obviously. But yeah, like $5,000, I would say is just the minimum for you to like really start live, period. Because again, like $5,000 just for like a stock that trades right around $50. And I mean, off the top of my head, like there's not too many stocks that are kind of in that price range that, I would really trust too much to be risking having to like hold the shares. So
right.
Yeah, I would definitely say from what it sounds like, you want to have enough money to where it's not turning into like YOLO, like reverse leverage, type of stuff where, like he said, his thing is profits and PJs. It's not profits, and a beater and some jeans, red eyes, you staring at the screen because you don't know if you made the right decision. Like he's trying to help, supplement income. Like somebody said, is this a good strategy during a recession? And I said, this is one of the better strategies during a recession because all of your portfolio is going to be falling. And this is a way that you could supplement some of the income in your house. And, and like you said, you might just get some gas money, but I'll take some gas money right now. Feel me? And you're not risking what you would be by necessarily buying a call or even buying a leap, during a time like this. The risk is a lot lower to where you'll either end up with shares and you could do the wheel strategy, or you'll end up selling your shares and hopefully you chose a strike that's higher than your cost basis, so you walking away with money anyways. So the way that he presented it, I do feel like he made it very simple. So don't try to overcomplicate it. Don't try to think too much about it. If you want to go deeper into it, you know, we can go deeper into it. I know he opened up his Instagram. So if you have additional questions, you can ask him. If you want to come back and maybe do other strategies, you know, we always open to that. But honestly, the information and the presentation he just provided us with, even for me, who I knew a little bit about this, and I know a lot of people who do it, but I never really knew enough to feel comfortable doing it myself. Where now, honestly, I do feel like, you know, this is something that I'll at least start paper trading just to, you know, test it out, because it seems like a very decent way to make some additional money. And when you have kids, you know, an extra $100, $200, that's cool. I'll take that, you know, just from a click of a button, and, you know, knowing technicals that we already know. You feel me? Like he said, you watch the resistance, you watch the support, you watch the averages. It's the same stuff you already watching from buying calls and puts. You just doing the reverse. You feel me? So I think that's about it.
Yep. Just one other thing too, like right now the market's like, as Tiva was saying, we're in like a recessionary environment. We're in a bear market right now, and a lot of stocks are trading at discounts. So even if you were to get assigned on like those cash secured puts specifically, like now you have a great cost basis to the point where you start doing this strategy like at a time like this, once the stock market starts going back up, like you can get assigned at a strike price that's like well above your cost basis. Now you bank a good amount of money just from the shares appreciating, on top of the fact that you've been collecting premium this entire time during the red days. So yeah, I would definitely.
I think that's something that really stuck out to me, is that, you know, with this strategy, you know, when you selling, like you said, you know, you might get assigned AMD at $80, but it's like, if AMD goes back up to 140 and you have 100 shares that you could afford to hold, that's money. You feel me? So it's like your risk is a lot lower doing something like this, only because of the method. Right. It's not just going to zero. Like, if anything, you're gonna get the shares, or on the reverse end, if you have to sell your shares and you use the strike higher than your cost basis, you walked away with money anyways. You feel me? So for people that are risk averse, I would definitely suggest, you know, starting to paper trade this, starting to do more to learn about this, because it's essentially free money in the market if you do it properly. And it's a lot of people. I mean, this young man is 24. 24, teaching us, you know, older folks. You feel me? I'm almost in the 30 club, so I refer to myself as older folk now. You know, I found a gray in my beard the other day. I'm acting different, you know, but he retired himself, and he's able to teach this to other people. He's taking the time to use his social media to not be on no games. You know, I don't know if he got no shirtless pics. I know them bodybuilders, you feel me, they like to show you the packs every now and then. They might catch you with an 8-pack story. I don't need to see that, but my man, you know, he doing this thing. And so, you know, just as people who are trying to find ways to make money, you know, during a time where money is scarce and becoming less and less, definitely paper trade this.
Facts. And then just make it make sense. Like he said, don't be selling puts against stuff that you don't want to own. Like, if worse come to worse and you get assigned, like, at least you assigned on something that you like, you know, something that you can see bouncing back in 5 to 10 years if you do hold the stock. Whatever the case may be, just make smart moves. That's all. Just make smart moves. I actually like it, to be honest. I'm gonna definitely around with it. Yeah, I'm gonna definitely be playing around with it for sure. But all right, we know it's July 4th weekend. Y'all probably with your families and whatnot. We're not gonna hold y'all too long. We're gonna do the week ahead rundown and get y'all out of here. So first thing first, earnings. I'm not really looking at too much for earnings. I mean, it's not that many companies reporting this week. I mean, you got like Levi's, WD-40. So like I said, I'm not really paying attention to too much earnings this week. I do want people to be mindful. If you don't know, it is a bank holiday. So tomorrow the market is closed. So it is a short week. So be mindful if you're a day trader, whatever you do, just be mindful that, you know, the market is closed tomorrow. Also, not looking at many conferences this week either. However, I will be looking at the Ford report of monthly U.S. sales that comes out on Tuesday. Also looking into the Spirit Airlines and Frontier deal. They have a shareholder vote, so just looking to see how that's going to affect the airline industry. In terms of economics, though, we are loaded. Okay, we are loaded this week with economics. So first thing first, on Wednesday, all right, Wednesday, we got the JOLTS. That's the job openings report. Okay, so be mindful about that. We also have info in reference to the ISM services. Okay, so that teaches you about, the orders, inventories, output growth, things of that nature. Another thing that we'll be looking at, FOMC meeting minutes. Okay, that's also on Wednesday. So discussing basically what we already know about the 0.75. Maybe, there's a lot of Fed people talking this week. So make sure you keep your head on the swivel, a couple of them being hawkish. So just be mindful about that this week. On Thursday, we have the ADP non-farm employment payrolls. Now, granted, I think I was reading something about them changing the strategy on that. So I'm not quite sure, if we should, take that serious right now until they come up and I actually, educate myself on the changes that are being done to how they calculate those non-farm employment numbers. But we also have unemployment claims, crude oil inventories, natural gas storage, and like I said, many FOMC members speaking. So Friday, we have our average hourly earnings. We have a non-farm employment, and we also have the unemployment rate as well as consumer credit. So seeing how consumers are spending during this time as well. So like I said, this week, not so much on the earnings and conferences front, but the economic reports are loaded this week. So with it being a short week and with the economic reports being heavy, it could be very volatile. So just make sure you're being careful in the week ahead. Also, don't sleep on the bond market. That's my gem for y'all. Don't sleep on the bond market. And that's all I got for y'all.
All right, AJ, we definitely appreciate that rundown. It's a 4-day week, so beginning of the month, so you know they're gonna try to throw a curveball.
First quarter,
stay focused.
Q3, yep.
All right, stay focused. No leverage, no super risk. This is not that environment. As you can see, we in a very, very clear downtrend. The start of the year was the top. We've been breaking all type of records, especially the bond market. The bond market, this is the nastiest the bond market been like ever, especially during the down year. So
hey, that bond market.
Listen, man, for real, keep doing y'all homework, man. And even I was thinking like some of the research that people used to do back when we was in a bull market was a lot more extensive than they've been doing now. And I'm going to tell you right now, with some of these levels, like these levels aren't going to last forever. You feel me? Some of these stocks are not going to be at these discounts forever. So make sure y'all are still doing that same homework, going through them documents. It's harder when your portfolio is down. It's discouraging. I feel you. But you got to do that homework now, because now is when you actually go get the prices that's going to pay off, in 5, 10 years, 20 years, where when you buying at the high, you might get a cool 5%, 20%, where here you might be looking at some 200, 300%, if you hold them long enough. So just keep doing y'all homework, man. Don't get discouraged, and keep that community where we all helping each other. Like Cam came to help us today. We appreciate that. He just gave a presentation that could make all of us some money. That's a blessing. So make sure y'all thank him. And if anybody else got anything that y'all want to present, please let me know. Cam, do you have anything else for the people?
I would just say that not really stock market related, but the sprint is saturated and the marathon is not, meaning that it's easy for people to like show up and be motivated for like a little short period of time. But once times start getting rough, like we're seeing right now in the stock market, like the people who are still sticking around doing their research, still willing to buy and invest and take those risks, like those are going to be the ones that come out on top and everything. Like there's a ton of people who started investing in 2020 and early 2021 that they're not really around anymore. But you guys watching this right now, that just shows that you're dedicated to this, you're dedicated to building your wealth, and that's going to pay off for you, in the years to come. Like, it might not happen overnight. There's still going to be some painful days. The indices are still going to probably be bloody until the Federal Reserve, starts being nice again. But eventually, this is going to pay off. So I guess those are just like the last little things that I want to leave everybody out on. And I appreciate y'all for having me.
Thank you.
We appreciate you, bro. Make sure y'all go follow this man. Hey, if you ever want to come back, you ever want to present anything else, just let me know and we'll set up another one. All right.
For sure. Appreciate it.
All right, y'all.
Happy to help.
Bro.
What you say, AJ?
I said in his PJs. I love it.
Facts. Facts. All right, y'all.